Good morning, everyone, and thank you for joining us this morning for another webinar presentation by Counselor Buchanan and Mitchell. Today's presentation is entitled The Employee Retention Credit, How Qualifying Businesses Can Utilize Pandemic Relief Legislation. And our presenters today are John Comunale and Tom Hudson. John is a Senior Vice President at Counselor Buchanan and Mitchell and serves as a Director of CBM's Automotive Group. He has more than 30 years in public accounting, serving businesses in the Washington, D.C. metropolitan area and the Mid-Atlantic region. John provides businesses and their owners with audit, accounting, tax, and consulting services, and he has handled large and complex dealer groups, providing them with consolidated financial reporting and taxation and multi-state tax services. John has also been a trainer on subjects such as the impact of the SBA's Paycheck Protection Program on small businesses, business taxes, accounting, fraud, and operational issues. He has shared his expertise presenting for groups, including the Washington Area New Automobile Dealers Association and CPA Academy, a national provider of certified professional education. Tom Hudson is a tax supervisor at CBM with nearly 10 years of experience managing income taxes, personal finance, and public accounting services for clients. His experience is primarily composed of complicated business income tax returns and compilation and review engagements. He is a common presenter on issues such as the SBA's Paycheck Protection Program, tax developments, and keeping business owners and individuals informed of best practices, and he helps lead the firm's committee responsible for understanding and consulting with clients on their eligibility for the Employee Retention Credit. Once again, thank you for joining us this morning. Please do keep your video off as a courtesy to our presenters. Thanks to those of you who submitted questions during the registration process. Those have been shared with our presenters and will be addressed during the presentation. But if at any time you do have a question during today's event, please feel free to use the chat box and our presenters will handle them after the content of the presentation. The session is being recorded today, and a link to the session and presentation slides will be sent out to all attendees after the webinar. If for whatever reason we do not get to your question today, the final slide on the presentation slide deck will have the email addresses for our presenters. So thanks one more time for joining us, and I'm going to turn it over now to John and Tom.
All right, everybody. Good morning. Today, we're going to talk about the Employee Retention Credit, and we're going to go through all the ins and outs of that specific program and the aid that it can provide to you and your business. Again, this is John Comunale. He's the man. He's our auto pro, and he's got a lot of accolades, and we like to thank him for his support throughout this program and all the guidance he's provided to us. Again, I'm Tom Hudson, and I've been following ERC, PPP, and all the different types of aid that have been coming out of the CARES Act ever since they were implemented way back in March of 2020. It seems like it was just yesterday, but these programs have continued to evolve. They've been moving targets. There's been information released every few months that substantially changes these programs. So we've been trying to do our best that we can to provide everybody with information on them, how they've changed, and really to keep up and to make sure that nobody misses out on any type of credits or aid that they may be entitled to. And of course, we are keeping in tune with our firm's missions, which are to inspire you and to provide you with the advice that you need in order to flourish yourself as a growing business, not-for-profit, whatever type of entity you may be. So what are we going to cover in today's presentation? First, we're going to give you an overview of the Employee Retention Credit. It's a massive payroll tax credit that could easily start approaching very high numbers based on how many employees you have. So, and this is a refundable tax credit. So this is cash coming back into your pocket. So if your business might be having issues, receipts are down, you reach eligibility, this influx of cash could potentially provide a lot of different things for you and your business and keep the doors open. So we're going to just run through the overview. We're going to discuss how to be eligible. There's a lot of confusion around whether or not I am eligible, and that's partly due to the two different sets of rules you have to abide by. 2020, it's a little different from 2021. So those rules and criteria do change when depending on which year you're evaluating. Also, there's two parts to eligibility. We'll go through both of those. One has to do with gross receipts. The second part has to do with whether or not your business was fully or partially suspended. What does that mean? We're going to cover that. After that, we're going to go through calculating the credit. We're going to discuss what wages you could use to calculate this credit, necessarily what the high-level process will be for figuring out the amount of the credit that you are eligible for, and we're going to walk through that process for you guys. Next, we're going to talk about the interaction with the Paycheck Protection Program. You can only use $1 of payroll towards one of these different types of aids. So the CARES Act included a ton of different things that you can use for your business, the Paycheck Protection Program and the Employee Retention Credit, to name a few, FFCRA as well. All of those really can't provide you with any type of double benefit. So we're going to discuss maximizing the amount of aid between these programs and ensuring that you take the steps, whether that's on the PPP side or the ERC side, to allocate wages appropriately and maximize how much you could pull from these different types of aids simultaneously. And then last, we're going to talk about how to claim the credit. Okay, I've often told some clients that I've worked with that it's a little bit of the wild, wild west out there in regards to claiming this credit. There's some guidance that we're still waiting on, but we're going to tell you what it's looking like right now, and we'll step through that process as well. So first, let's just talk about the evolution of the employer retention credit. As I said previously, it was introduced back with the CARES Act in March of 2020. This is a completely new credit, so it's not something that maybe you just didn't hear of. It was entirely not in existence before the CARES Act back in 2020. That's when it was originally introduced. It didn't get as much attention as it should have, perhaps, because back when this was introduced, the PPP was also in the CARES Act, and you had to choose between utilizing the Employee Retention Credit or the Paycheck Protection Program. For the majority of cases, the Paycheck Protection Program just made more sense, and that was the program that received all of kind of the media and all of the marketing, I guess you could say, from the federal government. And PPP really was the primary source of aid for so many different businesses, as I'm sure a lot of you know. But it was in existence. I want everyone to understand that. ERC came out the same exact time as PPP. Now, when we start getting through 2020 and approach the end of the year, there was the CAA, the continuing the CAA. And so what that did was it made some changes looking back into 2020, and it said, hey, you are now allowed to use the Employee Retention Credit if you also utilize the Paycheck Protection Program loan. That opened the door to the ERC for tons and tons of folks who had previously not given any attention to it. So that really is what made this credit much more important, is that, hey, everyone is eligible for this now. And it was poorly timed, essentially, because in the end of 2020, we're, of course, past all of the different payroll quarters that have already happened. And so it presented an issue, well, how do we go back and amend and claim this credit for quarters that have already passed and for which we've already filed the 941s? We'll get into that later in the presentation. But it made retroactive claims possible for anyone who had to choose between a PPP loan and the ERC. So with the CAA, the Employee Retention Credit was made law throughout June of 2021. So it stops right in the middle of this year. When we just passed ARPA in the beginning of March this year, that extended the ERC throughout the entirety of 2021. So previously, we were only looking at 2 quarters for which the credit would apply, Q1 and Q2 of 2021. ARPA extended the credit all the way through the year into Q3 and Q4 for 2021. So substantially doubled the amount of time which you can reach eligibility and make a claim for the credit. Let's talk high level. What is this credit? So to be clear, this is a refundable payroll tax credit. It's not an income tax credit that you would handle on your income tax return. This is entirely refundable if you choose to make that election. and it's refundable to the extent that it exceeds any payroll tax obligation that you would have on your 941. You will receive a check from the United States government in the amount of this credit. If it hasn't gotten your attention already with being refundable, let's just focus on the numbers that are on the screen right now. If you're eligible for the credit through 2020 and 2021, meaning you meet the eligibility criteria throughout the entire period of existence of this credit, you're looking at a credit of up to $33,000 per employee. And this is through 2020, since the inception in March through the end of the year, and then also all of 2021. This credit can easily approach mid six figures for a company with 15 to 20 employees. That's how substantial this credit is. So let's talk about those numbers a bit more. For 2020, the credit, it's up to $5,000 per employee that received $10,000 of qualified wages during the year. Okay, so the maximum credit you can receive throughout 2020 is $5,000 per employee, and that's throughout the entire year of 2020. I want to make that very clear. For 2021, the credit gets even better. It gets more generous. It's up to $7,000 per employee who received $10,000 in wages per quarter. So this allows essentially for 4 iterations of the credit to be claimed during 2021. So very important distinction. 2020, 1 claim for $5,000. 2021, 4 claims for $7,000 per $10,000 in wages. John.
On the 500 full-time employees, the aggregation rules apply here. So if you have 6 companies with 90 employees each, and they all have common ownership, then you would be considered a business with more than 500 full-time employees.
Yeah, that's another thing that you're going to have to consider as we look here at this slide. For businesses, if you had more than 100 full-time employees in 2019, again, we're looking at 2019, and this is using the old Obamacare measurements where they look at a full-time employee as somebody who worked 30 hours per week, right? So if they're under that, then they don't get any value in terms of an FTE count. They need to be over that 30 hours per week to get a value of 1. You're going to look at that, what that is throughout 2019. Those are the measurements that you're going to have to take. And if it's over 100, that doesn't mean you're not eligible for the credit. It just means that different employees are going to be eligible for the credit. We'll get into that a little bit later. But important distinction, in 2020, that number is 100 employees. So if your organization through common ownership starts to pass 100 employees for 2019, it makes it a little bit harder to qualify for the credit. It doesn't mean you do not qualify. We just have to look at this differently and look for employees who were paid essentially to remain home. If in 2020, it gets even wider here. So they look at 500 employees being a large employer. So that is the line in the sand there. They just increase the amount of companies who would be eligible for the full credit based on all the wages paid, regardless of whether or not somebody was working during the time period. So very important distinction, and John is right. Those aggregation rules do come into effect, and those are the same ones that we apply to a lot of different programs. It has to do with common ownership, and we can evaluate that with you to make sure that you're in compliance in regard to employee count. But
and Tom, if you have a full-time employee during one of those periods, but only working 60% of the time providing services, the other 40% would be eligible?
Yes, that's correct. It has nothing to do with hours worked or anything during the evaluation period and your period of eligibility. So let's talk more about the eligibility criteria, okay? They're different for 2020 and 2021. What is the primary difference? It's highlighted in bold on the screen here. In 2020, in any quarter during 2020, since the period of inception, so this was introduced in March, so they said to include that little first part of March here in the second quarter analysis. So you're going to be looking at Q2, Q3, Q4, back to 2019. You need to have had a drop in gross receipts amounting to 50%. So in 2020, if your gross receipts were 50% or less than what they were in 2019, you are eligible for the credit for that entire quarter. It's different in 2021. 2021, that threshold is decreased down to 20% drop in gross receipts compared to 2019. Again, we're still going back to 2019, and that's what the federal government determines as what was pre-pandemic. So everything was great in 2019. So we're going to measure back to 2019 for both years, 2020 and 2021. Do note that if you do not meet these gross receipts thresholds, that doesn't mean you don't qualify for the credit. A lot of clients that I have spoke to have said, I didn't meet those gross receipts, I guess I'm missing out on this. No. One of the biggest parts, and probably it's more difficult to kind of evaluate than the gross receipts test, which is very black and white, is whether or not your business had a fully or partially suspension of its operations due to a government order which limited commerce, travel, group meetings, anything due to COVID-19. Now, this is very broad, okay? All we have from the IRS right now is a very long document which gives us 90 or so questions and answers with examples about who would qualify under this full or partial suspension of operations. We're going to get more into this in detail on another slide, but right now you need to understand that the eligibility criteria is either the gross receipts to meet that drop that's specified for each year, 50 or 20, and then also whether or not you're fully or partially suspended. More to come on that. Let's talk about gross receipts first. So when we say you need to measure your gross receipts, we got to look at your gross receipts. What numbers on your financial statements are we necessarily discussing and talking about? Gross receipts, it's defined for the purposes of this program as any of the receipts during the year, the taxable year, and all of these periods that we're talking about are calendar year, to be clear. If you're a fiscal year, it doesn't matter. We're looking calendar, quarter, okay? So it's going to include gross receipts, total sales, net of any returns and allowances. So if you're refunding money, that doesn't count. And all amounts received for services, sales of your product, etc. So this will also include any income from investments, anything from incidental or outside sources. How I like to term this is that it is all of the money coming in the door. Okay, it can get quite messy if you have a lot of different revenue streams, but if you have one clear and concise revenue stream, as this is how you make your money, then that would essentially be what you're measuring in terms of gross receipts. So sometimes you might have to look into the financials, understand what is really coming in the door for you, and we have to look at that. What isn't included is things like sales tax, if you have to deal with that you are holding and acting as an agent and kind of the pass through to remit those funds to the federal government. That's something that wouldn't be included. Another piece to note that would be if you receive PPP loan, that is of course not included in your gross receipts, so you can pull that out as well. They're trying to get a measure on how much money your business has collected, and they're trying to measure how that compared back to 2019. So if there wasn't any substantial change in your business or the makeup of what your entity does, then everything should be quite comparable back to 2019, and they're looking to measure that performance drop. So other things, anything that is really derived in the ordinary course of your trade or business, that's really what is gross receipts. And I wanted to note here, it doesn't include unrealized gains. A lot of the not-for-profits we've been working with, they have large portfolios and they track the unrealized gains moving about the portfolio. And everyone knows that the stock market was definitely going gangbusters in both directions in 2020. And that was having impacts on folks' financials, but that's something that you need to pull out. If you're buying and selling, that's something you'll need to consider into the gross receipts, because selling proceeds, it's something that needs to come in the door. That's money coming in the door. So it needs to be evaluated. And of course, this is a thorough analysis that'll need to be done, especially if you're teetering on that level of what the threshold is, either the 50 or 20%. So very broad. Not a lot of clarification as to when you get into the details about this. Is A included? Is B included? Do I include C? They gave us a broad definition and cited a few specific things. So we're going to have to analyze this, and it can be quite arduous, but that's part of the program as it stands right now. let's talk about fully or partially suspended. Very, very broad terms here. Okay, so it discusses a government order that includes any proclamations, they say, any decrees from the federal government, the state or local governments, or anything else that has some sort of jurisdiction over your operations as an employer. One of the examples that they said does qualify as one of these government orders would be a state's emergency proclamation that residents must shelter in place for a specified period. Obviously, there were essential businesses excluded from that, but that's something so high and so broad that they say does meet the criteria for being something that was applied to your business and kind of restricted you. So what do you have to really start looking at? You could be partially suspended if government order allows you to continue your operation, but not all of your typical operations. And I understand that how I'm explaining this right now, it seems kind of unclear. Well, I did do this. This whole thing is about building a narrative for your business and your specific set of facts and your fact pattern. So this is going to be different for everybody. Everyone was impacted in different ways. You need to look at what restrictions were imposed on you as a business, what adjustments you had to make as a company in order to comply with all of these different orders. That's everyone standing 6 feet apart. That's people aren't allowed inside of your building or anything of the sort that everyone has had to go through throughout 2020. So very, very unclear, somewhat hard to decipher, but what we do have right now, as I referenced previously, is a long document where the IRS gives us examples. And so maybe we look for similarities for your company and those examples that are presented. And I have 1 or 2 or 3 here on the screen that I thought painted a good picture. The first one, it's a software developer, okay? Software developer, they were shut down by government order. They weren't allowed to go into their office because it was in downtown DC, and DC said, this is just a hypothetical, but DC said, you're not allowed to come down into your office. We're not going to allow it, okay? But the employer, they could continue what is defined as comparable operations by having its employees telework. Everyone was working at home and everything kind of continued the same as it was, except nobody was in the office. In this example, in the FAQ, the government says that in this example, that software company did not have a full or partial suspension of its operations. There's more details there because it mentions that this company allowed employees to work at home before, maybe 2 to 3 days a week, and it goes through, it gives a little bit more of a fact pattern here, but I'm just trying to paint a picture as to what type of analysis you need to do in analyzing the suspension. Next, there's the one where an employer, they had their operations that they say are partially suspended if the workplace is closed by a governmental order for certain purposes, but can remain open for other purposes. So in some circumstances, they talk about a store, right? You weren't allowed to let people come into your showroom or the area where you have goods set up for sale. People come in and browse and select what they want and buy it, but you were to continue online sales. They say that that is a clear partial suspension of your business, despite the fact that you may have still adapted and flourished as a company. Again, those gross receipts don't have to be down in order to meet this criteria. Go ahead.
For new vehicle dealerships, some of the states, the governor required their showrooms to be shut down. Parts and service was allowed to be open as essential, but due to the showroom being closed, then that would be considered a partially suspended amount of your business, and you could use that to be eligible for the ERC credits.
Yes, that is correct. What is the line in the sand here from the guidance that the IRS released on March 1st is they called, the original definition said a nominal portion of your business has to be partially or fully suspended, right? Then they came back and said that nominal amount means that this component at least composes 10% of your business's revenues. So when you are looking at the different segments of your business, if you have different parts of it, and one thing was impacted more so than others, and that activity comprises more than 10% of your revenue, then you would meet the criteria as set out per the fully or partially suspended definition. So that's the line in the sand that they've drawn, and that's really what you're going to have to look at it from a dollar value, 10% of all of your operations and the gross receipts from a certain activity. So for dealership, for example, sales versus service versus used sales, anything like that. So you can compartmentalize some of this and look at it that way. One of the great ones that everyone can relate to, everyone knows how restaurants were impacted. They include in the FAQ, hey, if there's a restaurant and you can only offer carry out instead of a sit-down service, then that is definitely a partial suspension. And if the business did great and made more money doing that, that doesn't mean that they're not eligible for this credit. The only criteria here is that you were impacted. I see a question here from Dominic. It's 10% of the gross receipts. So based on 2019 is the criteria that it throws out here. So we're going to be looking at that. Okay, so there's a question coming in. Someone's asking, and this is important. And guys, throw your questions out there. We could try to make these interactive so that we can address all the concerns that you guys have as participants. But someone asked, if there is a time limit for the suspension, how long did it have to be suspended? There is no time limit, okay? So as long as you were under those restrictions and it was imposed on your company, that is the period of eligibility that you have to look for wages that are qualified for this credit, okay? So when you're looking at the quarterly drops in revenues, that's going to determine eligibility on a quarterly basis. So if you meet the criteria, 50% drop in 2020, that quarter, that full quarter, calendar quarter, is what you are eligible for in terms of which wages paid during that time period can be claimed. The credit can be claimed against. If you're using the full or partial suspension, they're not going to fall under a quarter. It's not going to qualify for a quarter. It's going to be from the time that restriction was imposed upon you all the way through whenever that restriction was lifted, if it was. So there's two different time windows that can be created for which you're eligible based on which criteria, which eligibility criteria you meet. So that's something that you're going to have to look at and kind of nail down those dates as best as you can. Another question here, are the requirements for the reduction in revenue and a partial or full shutdown, or are they independent? That is a great question coming from Paula. So these are, I can't stress this enough, it's either or. You can meet one of these criteria and claim the credit. You do not have to meet both of these criteria. If you meet the gross receipts test, black and white, you are eligible for that quarter. If you meet the criteria for a full or partial suspension, you are eligible for the period in which that restriction, whatever you use to justify your eligibility under that logic, is in place. And restaurants, somebody asked about restaurants, limited to 50 to 75% capacity. Does that count? I think you have a very strong argument that your business was fully or partially suspended. In fact, that's one of the examples that they cover in the FAQ, and more so of a clear-cut case as to what was restricted. So that would be eligible for criteria as long as those restrictions were in place. So for 2020, someone's asking, what years are these criteria applicable? So the full or partial suspension, that is applicable for both years. The only difference between 2020 and 2021 is the gross receipts threshold, which you have to meet in order to reach eligibility. 2020, it's 50%. 2021, it is 20%. So when you're looking at gross receipts and analyzing them quarter over quarter, it's easier to achieve eligibility based on gross receipt drop in 2021. Because it's only a 20% drop that you're looking for. One thing to note, if you qualify on a 50% drop in 2020, you retain eligibility through all of the quarters until you reach 80% of your 2019 receipts. So it's 50% to become eligible, but then you gain an extra 30%. So if you bounce back a bit and you only had like a 70% drop in Q3 of 2020, you retain eligibility because you did not yet come back to an 80% threshold. So it's not just the quarter in which you hit 50%. They're waiting for you to recover and get get back to an 80% measurement of gross receipts compared to 19 before you lose that eligibility. So if you had a really down year in regards to gross receipts in 2020, you hit 50% in Q2, you bounce back a little, hit 70%, and then kind of maintain that throughout the year, you are eligible for the ERC based on gross receipts all through 2020. So that'd be from March 13th, the inception of the program, all the way through the end of the year. So one of the things that I wanted to hop into is the measurement of how large your company is. This is based on 2019. So we're looking back again to 19. And this is the old Obamacare logic that was implemented with that bill about how to measure employees. That has to do with an average of at least 30 hours per week or 130 hours of service in a month. If somebody did not reach that level of employment, their value in terms of an FTE count is 0. Okay, so anybody who goes over 30 hours per week or 130 in the month, that is a value of 1. So if you employ part-time employees who maybe work 20 hours a week, they don't count. And of course, for the purposes of this evaluation, you want to have a lower count, right? If you're flirting with that 100 employee level in 2020 or that 500 employee level here in 2021. So this is available to much larger businesses going forward into 2021. Again, this doesn't prevent you from claiming the credit. It just changes who is eligible for the credit. And that's in regards to whether or not you had to pay them, you paid employees and kept them home due to some type of restriction. So if you are under this line in the sand, that means all of the wages, no matter if somebody was in there working full time, if they were at home, still receiving compensation to keep them on the payroll, they would be eligible. So how do I calculate my FTE value for the purposes of this program? So step 1, you'd have to look at all the employees that you had in a calendar month in 2019. You need to evaluate the ones that are over 30 hours a week or 130 in the month. Anyone who passes that receives a value of 1. You need to look at that on average across 2019. So you're going to look at all of the people who meet that criteria and then, of course, divide it by 12. That's handled there in step 2. Again, those aggregation rules that we have to worry about still come into effect. So if you have multiple businesses through common ownership, you have to run this calculation at the higher level that incorporates all of the businesses who fall under common control. Very important. So let's talk about those qualified wages. We discussed what the eligibility criteria are. How do I meet that? And then really, am I sure that I'm eligible? So now let's assume all of those happen. You're eligible. We need to look at qualified wages. What are those? Qualified wages are all the wages paid to employees and then also towards a qualified health plan expenses that was paid on behalf of all your employees for the applicable quarter. Okay, so wages and healthcare costs. That's what you need to know are qualified wages. And what exactly goes into the healthcare portion? So it includes the employer payments that you need to make, and then also the employee contributions that they need to make on a pre-tax basis. So there's not a lot of numbers that you need to start pulling out and going in. It's essentially money to the employees and then the healthcare costs. A few questions rolling in. I'll get to those once we wrap up here with qualified wages. But so if no one actually received wages, but you still covered the healthcare expenses of certain employees, then those costs could qualify towards the credit. So in the event that your employees necessarily weren't getting paid, but you chose to continue their healthcare coverage during the periods of your eligibility, those wages can be allocated towards the credit and used in the claim for the credit. One of the things that we're going to get into in more detail is the interaction with the PPP, but to note here, you can't have any type of double benefit by using wages for the ERC or any of the other types of CARES Act aid. So of course the PPP and the FFCRA, and there's about 2 to 3 other programs that do claim and kind of make an election in regards to what the wages are going to be used for. So you can't use $1 of payroll for multiple programs, okay? They have to be allocated specifically to one program only. So we have a question here from Bill, and he asked, if you have more than 100 employees because of aggregation rules, you can apply for ERC for just one of the entities. So if I'm understanding this correctly, in your situation, if you have over 100 employees across all of your commonly owned businesses, you are eligible for the ERC, but only for the wages that were paid to employees who essentially were paid to not perform services. Best example of that is somebody who was sent home and asked to not come into the office, come into the business, and we will keep you on the payroll, but you can't come in due to any type of restriction imposed on us. So again, you're not ineligible for the credit if you go over these thresholds. It just means that your credit is now for a different pool of employees, a smaller pool of employees in most cases. So somebody who received pay that was retained on payroll, employee retention credit, in order to get them through the tough time, you paid them and they were at home not performing any services. If you're under 100, after measuring all across your employees across all these aggregated businesses that are under common control, then it means everyone is eligible for the credit. So anyone who was paid at all. That's the line, 100. Another question. This is for purposes of calculating the number of full-time employee. The credit part-time employee wages are still eligible for the credit. That is correct. Okay, so that's an important distinction. So when we're talking about measuring this, all of the wages paid during the period, and this is employees coming, employees going, as long as they received wages, they are eligible for this credit. So all of the payroll that you were paying, we're only using this FTE measurement to evaluate whether or not you're over that threshold for having all of the wages be available or just the ones who receive compensation for not performing any of the services that they're paid to do usually. So everything is eligible. This is just measuring whether or not you meet the applicable size standards of the program. All right, I'm gonna hop on to the next one here because I'm seeing a question about PPP. So we're gonna discuss this and how those programs interact with each other, and then hopefully it answers this question. If not, we'll handle it from there. I think the best way to think about how these programs interact is to really look at the PPP and the covered period as a type of bookends, really. So I have here a chart on the screen, and this is, I think, a great way to conceptualize this. Say back in 2020, you received your PPP loan, sometime in April or May, right? This program was introduced March 13th. So obviously there's going to be wages there that you paid to your employees before you received a Paycheck Protection Program loan. Those would be eligible for the ERC if you meet the criteria. And that's something that you can allocate to the ERC because they wouldn't be something that went towards payroll costs under the Paycheck Protection Program. Then think about when your 24-week covered period ended. If you received a loan in April or May, you're looking at October time frame. There's, of course, eligibility and wages that occurred after October into the end of the year for 2020. Those would be applicable to the program. I'm not saying that during this covered period where you were paying employees with using PPP funds that you can't allocate wages to the ERC. This is all tied to the reporting on your forgiveness application. And in some circumstances, the PPP, it limited the compensation of employees who earned over $100,000 annualized throughout the covered period. So remember, there was maximums, $46,000 approximately for employees who were over that $100,000 compensation limit. That's all that an employee could receive, maximum. If somebody was earning more than that, those wages aren't allocated to the PPP and are available for the ERC. So if you have highly compensated employees, that might be something that allows you to more easily qualify for the credit that happened simultaneously throughout your covered period for the PPP. So it's important that you really look at your wages per employee and you understand what exactly was reported or what will be reported on your forgiveness application that you will be submitting for forgiveness for round 1 of the PPP. If you haven't done your application, there is a little bit of, you have a little bit of a benefit in that you know exactly what the rules are for ERC heading into your forgiveness application. There were a lot of businesses who already submitted their application before all of this became more clear as of March 1st. And in general, it was so easy to fill out these forgiveness applications by putting all of the payroll costs onto the forgiveness application and submitting the application as such. No non-payroll costs, because that required more documentation. It provided us substantially no benefit to doing so. In the event that you fell into that group of applicants, how the IRS is handling these is saying that for all of the wages that achieved, that were put towards a PPP and helped achieve forgiveness, that's assumed to be an election to use those wages towards a PPP, and they cannot be used towards the ERC. So let's talk numbers. If you had a $500,000 Paycheck Protection Program loan and you put $1 million in wages on your forgiveness application, obviously there's $500,000 that were not used towards forgiveness, right? And this loan was fully received forgiveness. So this means that you have an extra 500, despite it being reported on that forgiveness application, that can be used towards the ERC. So if you reach eligibility throughout 2020, and then you also had a PPP loan, you have an extra group of wages, and you need to search. You need to evaluate what was used and what was allocated to which program in order to find the wages to obtain the credit. And again, you only need $10,000. And that includes the healthcare costs. So in the example I was just talking about, if you just included net pay and achieve forgiveness that way, you didn't report healthcare costs, you could look at claiming the credit just based on healthcare costs. And this can be a partial credit. If you only use $5,000 in wages, you can get half of the credit, so $2,500. It's not all or nothing. So there's a very fine dance that you have to do with the PPP and interacting between those programs. But again, you just have to really look at an employee level. You need to consider what wages you allocate towards a PPP, and you need to think about those compensation caps. For anyone who's over those, there may be wages there. And then you also have to look at what you did not report on your forgiveness application moving forward. So if you left the healthcare costs off, for example, if you have yet to file for forgiveness, our recommendation as it stands right now is that you put as many non-payroll costs on the forgiveness application as possible. Previously, as I said, that didn't provide much benefit, but what it does now is if you're eligible for the ERC as well throughout your covered period, and you put non-payroll costs on your forgiveness application, you are decreasing the amount of payroll costs that you need to report on that forgiveness loan application, and thereby increasing the amount of wages that are left over and eligible for the ERC. So think of it as two buckets. These payroll wages, these wages can only go in one of those buckets, ERC or PPP. And by, of course, including those non-payroll costs, you maximize the amount that would be available for the ERC. So that's an important note if you're going through that. And that's something we can assist with if you want questions, or if you have questions about filling out your forgiveness application. Of course, reach out to us and we can help you navigate that. One of the questions here about PPP, I'm just going to read this over real quick. Should you have already applied for first draw PPP forgiveness and used only labor as a criteria for forgiveness? Would that restrict you from qualifying? So first of all, it wasn't required that you have applied for forgiveness yet. Again, as I said, if you haven't yet, you're kind of in the best situation in that you can start allocating these numbers appropriately to maximize the benefit between the two programs now. It doesn't restrict you in any way from qualifying for the 2020 ERC if you meet the criteria and you've already applied for forgiveness. As I said, if you've got excess payroll, that excess payroll is available to be used with the ERC. And then we can also look at other costs that weren't reported, the healthcare costs. If you didn't report them on your forgiveness application, that'd be something that you can look at as well. All right. Before I get into claiming the credit, I just want to address some of the other questions here that are submitted. We have one from Tracy. She said, I'm in the trade show and conference industry, and we keep the majority of our staff on payroll. We kept the majority of our staff on payroll, but could not produce any events for the past year and seen a massive drop in revenue. My understanding is this applies to us due to the suspension of all work by the government requirement. Please confirm. So two things. If you meet that gross receipt drop, you are eligible for the quarter in which that drop applied. So if you're looking back to 2020, you're looking at a 50% drop quarter over quarter, and then you retain eligibility until you come back to 80% of your receipts. If you don't meet that, I think you'd have a strong argument based on your specific facts and circumstances that you couldn't hold any of these events due to these government restrictions, and you had to not hold them at all. And that would possibly be a very strong argument for meeting the partial or full suspension of your business activity. So again, that would be a discussion about your specific fact pattern, your specific circumstances, and really what restrictions were imposed on you specifically. But it sounds like that would most likely qualify for forgiveness or for eligibility for the credit. See, I'm mixing the programs up. We had another question here from Michelle. Only employer-paid health benefits were considered payroll costs. Sounds like you can use both employer and employee health costs. Is that right? Yes, that is correct. It does specify that you can use employee and employer health costs for purposes of qualified wages under the ERC. And then you clarify only employer-paid health benefits was considered payroll costs in the PPP loan. For the credit, it allows both the employer and employee. That is correct. That is correct. But in PPP, it was net pay. So anything that an employee did with their pay, of course, it didn't matter as long as that employee receives the funds, and that is eligible for help, forgiveness. So not a huge distinction. Let's hop back here. Let's talk about claiming the credit. Okay, we've walked through determining if you're eligible. We walked through an overview of the credit, really understanding what it is. We figured out the wages, and we know now, we've done the calculations. We've got very good support. We've got a nice set of documents that we can retain in the event that this gets evaluated. How do we claim the credit? So first, we're going to want to look as your payroll processor. Okay, if you use a major payroll processor, someone who files your 941s on your behalf, you're going to want to coordinate with them to see what information they want in order to file for this credit. Okay, I'm only saying that because I've spoken to a lot of the different payroll companies, and I've heard a lot from our clients dealing with this, is that there isn't a consensus about what they want. Some of these payroll processors say, you tell me the amount of the credit and we'll put it on the form. Some of them say, well, we can help you calculate it. Let's run through the wages. Let's look at it. And some of them are taking a more involved approach. So you're going to have to work with them, see what they're looking at, and what they require in order to get these filed. But if you're going retroactive here and you're looking at 2020, again, you weren't allowed to use this program until the end of 2020 based on your situation. Most cases, that's what happened. So if you're going to claim these, you need to file a 941X, which is an amended employer's quarterly federal tax return, for the applicable quarter in which you are claiming the credit. So if you're $10,000 in wages and your eligibility spans 3 quarters, you may need to amend all 3 of those quarters. And what you're going to do is, of course, amend and claim the credit on those 941s. That's how this works. You go back and you say, this is the credit I was entitled to, and that's what I would like to receive a refundable check. You can apply it forward to anything you may owe in the future, and you have to negate the payroll taxes that you owe before you receive any refundable credit. But you need to amend the applicable 941 for the quarter. Right now, the word is that those amendments and those adjustments retroactively are taking quite a few months to get through. So when we discuss evaluating eligibility and moving forward and claiming this credit, we've been suggesting to everyone that if you see eligibility for 2021 or the potential for eligibility for 2021, that is where you focus your efforts. And that's because when you are filing for the credit right now in 2021, and you include on your 941 a timely credit, those are going to get processed in real time. And that could result in a refundable check coming back to you much faster than if you were to focus your efforts on claiming a retroactive credit back in 2020. You may be eligible for both, but we recommend that you focus your efforts on 2021 for right now, because that will result in your business, your entity, in receiving those funds much faster. Again, there's multiple month backlog on all of the different retroactive adjustments, the 941 amendments that you're going to have to file going backwards. Okay. And I have a picture here just of the line. So everyone's like, how do we do this on a 941? I don't think it was there. And everyone's worked with a 941 for multiple years, but there's been a revision to the form, and it adds these lines here, as you see, 13D, refundable portion of the employer retention credit. and that it makes reference to a worksheet that you'll fill out in the 941 filing. So this is something you have to coordinate with your payroll provider. You're going to want to have all the calculations retained, everything that you need to really justify your eligibility, everything you used to substantiate that, and go forwards. Got some questions rolling in here. Somebody said, so for purposes of the 2021 ERC, if 2020 quarter exceeded 80% of the 2019 look-back year, you're automatically excluded from eligibility from anything in 2021. I'm not following 100%, but I will say that anything that happens in 2020 has no impact on your eligibility for 2021. These are two separate measurements. So for 2020, we measure back to 2019. For 2021, again, we're going to measure back to 2019. It's independent of what happened in 2020. Hope I made that clear for you. Somebody asked, is there an exclusion for S-Corp owner W-2 compensation? So this is unique. This is a good question. There's been a lot of confusion regarding S-Corp owner compensation. There is a stipulation in there where it says that if somebody is greater than a 50% owner, then anybody who is related to that owner, their wages are not eligible. So I think they're carving out family members of the primary owner of an S corp, but that owner's wages themselves are eligible for the credit. So if somebody was a 100% owner, yes, this is for both 2020 and 2021, their wages are eligible for the credit. But if they had a child or a spouse who also worked for the company, their wages would not be eligible. And that's the current interpretation. And there's a lot of disagreement over whether or not that's correct. And this is something that our organization, the AICPA, our group who advocates for us, is asking for clarification on. So right now, that's what everyone thinks, but that could change in the future, or at least be clarified by the IRS and the SBA. Good question. So let's just talk about assistance, right? This is very, just going through this presentation, it's clear that this can be confusing. It can be unclear. It doesn't exactly give you a clear yes or no about moving forward. I mentioned previously, it's about building that narrative. It's about analyzing your situation and your specific restrictions. Every company will have their own specific fact pattern that they'll need to follow. This event was canceled. This state and local entity said I can't do this, and that's a big part of my business. We need to evaluate that. It's a discussion. It can be unclear when you're looking at full or partial suspension, because while they gave us examples, there's going to be too many situations where it just may not be clear for you. So that's one of the risks of evaluating this program and looking at that. But again, the gross receipts are clear as day. If you meet that, that's what you're going to want to analyze first. If you meet those gross receipts tests, then that is a clear yes or no regarding eligibility, especially if it's way past the 50% or 20% threshold. So we're open to having these conversations with a lot of our clients and interpreting this. The best thing to do is go through, and what we do is we'll try to draw examples from the guidance that we've been provided and see maybe if that applies to your specific situation. And again, this is an argument, right? So we're going to have to evaluate all the specific facts and circumstances of your business. So we've talked about qualifying, we've talked about claiming the credit and how to claim it, going through all of this and working with your payroll processor. And I said before, it's a little bit of the wild, wild west. I feel like the payroll processors are still getting their act together in regards to assisting their clients. I've heard multiple things come from some of the big companies, depending on who you talk to. So if you run into any frustrations, of course, reach out to our team. We're following this since day one, and I feel like we're well versed in how to handle all of this. And we can assist you with communicating with your payroll provider, calculating the credit, and going through the entire process. Again, these are massive. This is a very large sum of money that some entities are qualifying for. So we want to make it clear that if you don't meet the gross receipts test, you're not out. There's still a chance that you qualify. And then, of course, we want to maximize the wages available between the PPP and the ERC, because the majority of the clients that we've been discussing this with also receive paycheck protection loans. And as I said before, it's a dance. And I think that's the best way to describe really walking the line.
Dealership related questions?
Sure. Somebody asked,
does the franchise SBA code exempt the entity from the aggregation rules? For the ERC, it does not. For the PPP loans, it did, but for the ERC, you have to include, you have to aggregate it. So if you're over the 100, those rules apply. If you're over 500, those rules also apply.
that is correct. We have a comment from our very own Judy Barnhard, and she asks, please address how the credit is accounted for in 2020 and 2021 on the tax return. Do you reduce your payroll taxes on your tax return for the credit? What if the credit is received the following year? That's a very good question. So if you have to consider financials and your tax return and you see that you're eligible for this credit, it could have an impact on your 2020 income tax return if we're going backwards and making a retroactive claim, because right now the word and the guidance is that you must reduce your payroll tax liability before you receive any of this refundable tax credit, right? So that means if you have payroll tax on the books, you're going to allocate the credit first towards that liability and negate it all the way down to zero. Anything exceeding that is the refundable portion of this credit. There hasn't been any guidance as to how necessarily that should be represented on any of the financials, because this program is kind of breaking a lot of the rules of accounting, the matching principle, and properly allocating everything to each period. I've seen a lot of conjecture, and this is something that the AICPA is also requesting clarification from the IRS on, and any other bodies who might have a say in how to do this. But it would essentially, in my opinion, be handled as revenue, and then on the income tax return, we'd make an adjustment to exclude it from revenue on the M1. So that's something that we'd handle from a tax perspective. From a GAAP perspective, I can't necessarily comment on that because I haven't seen any rules about how to specifically handle the income tax, the credit coming back and how that should be demonstrated on the books. So I can't speak to that myself. For 2021, it will be the same kind of representation on the financials, but of course, hopefully we're not spanning any years. Maybe for the fourth quarter, it could cause some issues. But again, this could cause issues if you're going through an audit in 2020, or you have your tax return that is waiting to get filed. It will have to be either if you file it now, it'll have to be amended after we find out how much of the credit you're eligible for, and we can make that change, or you can delay and of course extend your income tax return. So great point from Judy. This has repercussions on the books. Let's leave it at that. And lack of clarity right now at that moment. Last question we have from Paula: how does this affect payroll tax deferral? So in the notice from the IRS, it says that you can apply this refundable credit to any current obligations, and that does include any of the payroll tax that was deferred last year. So you could potentially negate that liability using the credit from 2020 instead of receiving the credit as an actual refund. So it's preference. If you want the cash in hand, that would be the approach you want to take versus applying it and negating any liability that you have on the books for payroll taxes that you deferred. So unless there's any other questions, we're going to wrap it up and leave it at that. I thank all of you for coming to this presentation and working through this with us. Again, it's Wild Wild West, I like to call it, but really it comes down to your specific fact pattern and all of the different situations, your specific situation that you've experienced, and your story from 2020 and 2021. So look into those gross receipts. Again, focus on 2021. If you're eligible, go for that current time period. Look for wages now here in Q3, Q1 2021, because we wrap it up here on March 31st. Include it on your current filing. You'll get that money back faster into your hand. Again, these are substantial amounts of money. So if you feel like you have a chance at eligibility and a large credit coming your way, please reach out to us and we can assist you in all aspects of the program, calculating eligibility and getting the credit claimed. We'd love to help you out because it's we understand how significant this can be for a lot of the businesses out there. So we have everything available on our resource center. That's what this slide is saying right now. You can go out there, check out everything we've been doing, ERC on PPP. We have upcoming events. Please sign up for those. I list them on the screen here. A lot of different topics. We're trying to keep everyone informed of everything that's going on. There's so much moving, and we're really just trying to assist everybody as best as we can and navigate a lot of these programs. So there's John and I. Those are our emails on the screen. That's how you can get in contact with us if you're interested in moving forward with the firm and having us assist you, or if you have general questions, we can assist with those as well. I strongly suggest doing so if you're a little unclear on a lot of the different aspects of the program, because we don't want to misstep here and miss out on a large refundable credit. So thank you all. Thank you, John.
Thanks, Tom. Thanks, everyone.
And everyone have a great day.